Let me ask you a simple question. If one person has $50,000 in cash, but no credit history, and another person has $5,000 in debt, but a perfect credit record, who do you think the American system trusts more? Most people instinctively answer the first person. Cash feels safe, debt feels dangerous, money feels real. But in the United States, that instinct is wrong. In America, trust is often more powerful than money, and that trust has a name. It is called credit. Credit is one of the most misunderstood ideas in modern life. People interact with it every day, yet very few people understand what it actually represents. Most people think credit is about borrowing money. It is not. Most people think credit is about debt. It is not. Most people think credit is about being rich or poor. It is not. Credit is something deeper, more abstract, and more powerful than all of these things. Credit is how the system decides who is reliable, who is risky, and who does not exist financially at all. Today, we are not going to talk about tips, hacks, or tricks. We are not going to talk about how to raise your score quickly. We are not going to talk about loopholes. We are going to understand the structure of credit. We are going to understand why America relies on it, how it works beneath the surface, and how it quietly shapes behavior, opportunity, and power. By the end of this narration, you will understand why credit is not merely a financial tool. It is a social system. Pause your assumptions. Let us start from zero. Part 1. What credit actually means. At its most basic level, credit means trust. Nothing more, nothing less. The word credit comes from the Latin word credere, which means to believe or to trust. Long before banks, before credit cards, before modern finance, the idea of credit existed as a social concept. If one person gave another person resources today based on the belief that they would be repaid in the future, that belief was credit. Modern finance did not invent credit, it formalized it. When a bank gives you a loan, it is not simply transferring money. It is making a statement about the future. It is saying, based on your past behavior, we believe you will act in a predictable way going forward. That is why credit is inseparable from time. Cash is money you already earned. Credit is money you promise to earn later. Cash looks backward. Credit looks forward. Think of credit as a bridge across time. It allows future income to be used in the present. But here's the most important idea to understand. The American system does not trust people as individuals. It does not trust intentions. It does not trust explanations. It does not trust promises. It trusts patterns. Patterns of behavior observed repeatedly over time. Credit is the system's memory of how you behave. If you pay obligations on time, the system records that pattern. If you miss payments, the system records that pattern. If you disappear during stress, the system records that pattern. Once recorded, this memory becomes part of how every other institution treats you. Credit is not personal, it is statistical. Why America needed credit. To understand credit, you must understand scale. America is a large country. It has a large population. It has expensive infrastructure. It has constant movement of people, goods, and capital. Pure cash systems do not scale well. In a purely cash-based economy, every major action must wait for savings. Homes take decades to buy. Businesses grow slowly. Infrastructure takes generations. That model works in small, stable societies. It does not work in a rapidly expanding industrial economy. Credit solves a specific problem: speed. Credit compresses time. It allows people to act before savings exist. It allows governments to build before taxes are collected. It allows businesses to expand before profits accumulate. America did not choose credit because it was moral. America chose credit because it was efficient. Efficiency matters more than morality in large systems. Credit allowed the United States to industrialize, urbanize, and globalize at a speed that cash alone could never support. Without credit, America would not function at its current size. Part 3. Cash cultures versus credit cultures. To understand credit more deeply, we must compare two types of societies: cash cultures. In a cash culture, you buy only what you can afford. Debt is viewed with suspicion. Saving is respected. Growth is slow but stable. Cash cultures value certainty. You move forward only after resources are secured. This model reduces risk but also limits opportunity. Credit cultures. In a credit culture, people act first. Payment comes later. Growth is accelerated. Risk is managed, not avoided. The United States is a credit culture. You cannot buy millions of homes with cash. You cannot build highways using savings alone. You cannot grow multinational corporations slowly. Credit enables housing markets, infrastructure development, business expansion, innovation. So credit is not immoral. It is not evil. It is an engine of growth. But engines without controls are dangerous. That is why credit systems have rules, scores, limits, and interest rates. In America, cash shows responsibility. Credit shows participation, and the system rewards participation. Part 4. Why credit exists at all. Now imagine a world with no credit. In that world, buying a home requires decades of saving. Starting a business requires inherited wealth. Education becomes inaccessible. Emergencies become permanent setbacks. Economic growth would slow almost to a halt. So credit exists to solve one central problem. How do we allow people to act today using money they have not yet earned without collapsing the system? The answer is risk pricing. Credit is not generosity. Credit is calculated risk. The system asks, how predictable are you? How often do you fail? How do you behave under stress? Do you recover after mistakes? Based on these patterns, the system assigns cost. Low risk to low interest. Higher risk to higher interest. Unknown risk to no access. This is why people with no credit history are often rejected. Not because they are irresponsible, but because they are unknown. In large systems, unknown risk is often more dangerous than known risk. Part 5. Credit is about behavior, not money. This is where most people misunderstand credit. Credit is not a measure of wealth. It is a measure of behavior over time. The system does not ask how intelligent you are. It does not ask how ambitious you are. It does not ask how much potential you have. It asks how predictable you are. That is why a high-income person can have bad credit and a low-income person can have excellent credit. The system observes payment consistency, credit usage, reaction to stress recovery after mistakes. Predictability allows planning. Planning allows lending. Lending allows growth. This is why credit affects far more than loans. Part 6. How credit shapes daily life. Credit influences renting homes, insurance pricing, utility deposits, interest rates, approval speed, job background checks. Credit becomes a reputation signal, not a moral judgment, a probability estimate. It answers one question. How likely is this person to meet future obligations? Once created, this score spreads across systems. Part 7. How the credit system works internally. Behind the scenes, credit systems collect enormous amounts of data. Every time you open an account, use credit, miss a payment, close an account, a record is created. These records are stored by credit bureaus. Lenders do not read your story. They read your record. Algorithms analyze payment history, credit utilization, account age, recent activity. From this, scores are generated. Scores are not judgments. They are probability model. Part 8. Who benefits from credit? Credit benefits. Banks through interest. Businesses through faster expansion. Governments through economic activity. Consumers through early access. But credit also encourages debt, punishes mistakes harshly, rewards stability over creativity, traps the uninformed. Credit itself is neutral, like fire. Part 9. Credit as social control. Credit quietly shapes behavior. If you want lower rent, lower insurance, better interest rates, faster approvals, You must behave in ways the system prefers. Stable employment, predictable spending, long-term planning. Credit does not force obedience. It incentivizes conformity. Part 10. Credit, freedom, and constraint. Credit increases freedom in one important way. It allows people to act before they have saved enough money. Because of credit, a family can buy a home before saving for decades. A student can get an education before earning a full salary. A business can expand before profits arrive. In this sense, credit accelerates life. It pulls future opportunity into the present. But credit also limits freedom in a different way. Once you depend on credit, your future behavior matters more. The system begins to watch for stability. It rewards people who stay employed consistently, spend predictably, and avoid sudden changes. At the same time, it quietly discourages behavior that looks unstable. Changing jobs too often, taking long breaks from income, trying uncertain or unconventional paths. These actions are not wrong, but they are harder to measure. Credit systems do not understand creativity, ambition, or potential. They understand patterns, so credit encourages people to choose safer paths. It pushes people toward steady jobs instead of risky ventures, regular payments instead of flexibility, predictability instead of experimentation. This creates a trade-off. Credit gives you speed and access early in life, but in exchange, it asks for consistency and conformity over time. This trade-off shapes modern life more than most people realize. Part 11. What credit is and what it is not. Credit is trust measured over time, a behavior record, a risk pricing system, a speed accelerator. Credit is not free money, a reward intelligence, human worth. You are not your credit score. But the system often treats you as if you are. Part 12. The bird's eye view. Step back. Trust leads to behavior tracking. Behavior accumulates over time. Time creates access. Access creates power. That is credit. Not morality, not punishment, not kindness. Just a machine. Once you see the machine clearly, you stop being crushed by it and start navigating it intelligently. Conclusion: what comes next? Now you understand what credit really is. In the next video, we will ask a deeper question. Why does America run on credit at all? Why not cash? Why not savings first? Why not slow growth? That answer explains student loans, housing prices, economic speed, and modern financial stress. That is the next chapter. Why America runs on credit. Subscribe to know about USA System.